Why 90% of traders fail. It's not what you think. Most people who hear that phrase assume they already know the answer. They say, well, obviously they fail because they don't know enough about the markets. Or they fail because they don't have a good strategy, or they don't know the right indicator, or they don't have the correct insider information. Others say they fail because the markets are rigged, or the big banks always win, or high-frequency trading makes it impossible for small traders to succeed. All of those sound reasonable. They contain a grain of truth, but none of them identify the main reason. In this video, we're going to walk through what is actually destroying most traders, and why it has surprisingly little to do with charts, indicators, or how smart you are. We'll break down the real drivers of failure, the hidden traps that almost everyone walks into, and the mental rewiring you need if you want any chance of being in the 10% who don't blow up and quit. Let's start with something uncomfortable. If you have traded before, you probably already know this pattern. You spend hours learning a strategy. You feel confident. You get a few nice wins. Then suddenly, you hit a string of losses. You start tweaking the rules. You double your size on the next trade to make it back. The market moves against you. Before you know it, you've given back weeks or months of profits in a few hours or a few days. And you say to yourself, I just need a better system. Or, I just need more information. Or, if only I had started with a bigger account. So you look for the next strategy, the next indicator, the next market, the next guru. But here's the part people don't like to hear. If you gave most failed traders a perfectly profitable strategy with a real positive edge, most of them would still lose money over time. Read that again in your mind. The majority would still lose money, even with a consistently profitable method. Why? Because the main reasons traders fail are not about strategy. They are about behavior. They are about how humans respond to uncertainty, risk, reward, pain, and the constant stream of information that markets throw at us. You are not trading the market as much as you are trading your own nervous system. The market is just the amplifier. Think about this. The market has no emotions. It doesn't know who you are. It doesn't know your entry, your stop loss, your dreams, your fears, or your deadlines. It simply moves, up, down, sideways. Yet when price moves against you, your heart speeds up. Your breathing changes. Your mind starts telling stories. What if I'm wrong? What if this is the big move and I'm on the wrong side? What if it just comes back if I hold a little longer? I can't take another loss. I need this trade to work. All of that drama is not in the market. It's in you. So why do 90% of traders fail? The short answer is this. They are trying to solve an emotional problem with a technical solution. They keep thinking, if I find the right indicator, or tweak the right setting, or follow the right guru, my emotions will go away. I'll finally feel calm, confident, and in control. But your emotional reactivity doesn't come from the chart. It comes from decades of conditioning around money, reward, punishment, and uncertainty. It comes from your identity, your ego, your need to be right, your fear of missing out, and your fear of loss. And this is exactly why more information, more screens, more indicators, and more opinions usually make traders worse, not better. You are throwing gasoline on an emotional fire and then wondering why the room keeps heating up. In this video, we are going to explore 8 core reasons why traders fail that have almost nothing to do with the specific strategy they think they need. As you listen, notice which ones feel uncomfortably familiar. Those are the ones sabotaging you right now. Let's begin with the first and most fundamental. Traders fail because they misunderstand what trading actually is. Most new traders think trading is about predicting where the market will go next. They think it's a game of calling tops and bottoms, of being right more often than they're wrong. They secretly believe that if they are smart enough or if they work hard enough, they should be able to know what's coming. So they treat trading like a test, where their job is to get the answer right. This belief is toxic. Trading is not about prediction. Trading is about making decisions under uncertainty. where you never have full information, and where even the best decisions will often have bad outcomes. Let that sink in. You can make a perfect decision and still lose money. You can make a terrible decision and make money. That's how probability works. That's how variance works. That's how any game of chance with a small edge works. Professional traders understand this deeply. They don't expect any single trade to work. They expect a series of trades executed consistently over time to reveal the edge. Most failed traders never truly accept this. They say they understand probability, but their behavior exposes them. They overreact to one loss. They double their size after one win. They abandon strategies after a short losing streak. They change rules on the fly. In other words, they treat every trade as if it has to be right. When you believe you should know the future, the market will feel like it is constantly insulting your intelligence. You will feel attacked by randomness. So you will chase certainty in all the wrong places: prediction gurus, magical indicators, secret volume tools, and more. The reality is this: trading is a process of saying, given what I see right now, and the rules I have tested, and the risk I am willing to take, this is a bet I am willing to place, knowing full well it might lose, and being completely okay with that outcome. Until you truly internalize that, your psychology will never stabilize. The second big reason traders fail is this: they do not design their strategy to fit their own emotional wiring. Most traders ask, what's the best strategy? What has the highest win rate? What has the highest profit? Those are the wrong questions. The right question is, what type of trading fits my specific temperament, my schedule, my tolerance for boredom, my tolerance for drawdown, my ability to sit in front of a screen, and my emotional response to risk? Some people cannot handle the speed and intensity of day trading. Their nervous system is not built for rapid-fire decisions for hours at a time. They get exhausted, impulsive, and sloppy. Some people cannot handle trend following because they hate watching open profit fluctuate for days or weeks. They keep cutting winners early and never let the edge play out. Others cannot handle mean reversion strategies, where you're often buying when price looks weak or selling when it looks strong. The trades just feel wrong to them. Here's the key: if your strategy constantly fights your natural tendencies, you will unconsciously sabotage it. You will override rules, take random trades, skip valid setups, exit too soon, hold too long, and then blame the system. It's like trying to force yourself to be a professional marathon runner when your body and mind are wired more like a sprinter. You can push for a while, but you'll burn out. And along the way, you will start making excuses like, marathons don't work, or the shoes aren't right, or the weather is bad. Traders fail because they pick strategies that look good on paper, but feel terrible in real time. They never take the time to say, who am I as a person? And what style of trading matches that? Do you like structure and routine? You might do better with systematic trading and fixed rules. Do you hate micromanaging and staring at screens all day? Swing or position trading might suit you better. Do you enjoy fast decision-making, high energy, and constant engagement? Then scalping or intraday trading might be your arena, but you must still manage your emotions. One size does not fit all. The illusion that there is one best strategy blinds traders to the fact that they themselves are part of the system. The third reason traders fail is this: they grossly underestimate the power of position sizing and risk management. Almost every blown account can be traced back to one core problem: position size that is too large relative to the trader's capital, experience, and emotional resilience. People don't blow up because of one losing trade. They blow up because that one losing trade was way too big. Most new traders focus almost entirely on entries. They obsess about the perfect place to get in. They watch YouTube for magic patterns. They look for sniper entries. But imagine you flipped a fair coin. Heads, you win $1. Tails, you lose $1. That's a game with no edge. It's break even in the long run, minus transaction costs. Now imagine you had a slightly loaded coin. Heads, you win $1.1. Tails, you lose $1. That is a real edge. Over enough flips, you will make money, if your bet size is sensible. But what if every time you flip, you bet half your net worth? Even with an edge, a short streak of tails will wipe you out. You will never survive long enough to realize the positive expectation. This is exactly what happens to most traders. They may or may not have an edge. In many cases, they don't. But even if they did, their position size is so reckless that a small run of normal random losses destroys them. Why do they do this? Because emotionally, they are not trying to trade. They are trying to get rich quickly. They don't want to compound steadily at a realistic rate. They want to double the account in a few weeks, or turn a small stake into a fortune. So they start trading size that makes them uncomfortable. And here is the twist. Once your size is too large for your emotional comfort, your decision-making degrades rapidly. You move stops. You exit early. You hesitate on valid signals. You jump back in out of frustration. You deviate from your plan. It is not just that big size increases risk mathematically. It also destroys your ability to follow rules. Then, when the inevitable losing streak comes, it hits you financially and emotionally. You feel panic, shame, and desperation all at once. And you start making exactly the kind of impulsive, revenge-driven, rule-breaking decisions that dig the hole even deeper. Professional traders think almost obsessively about risk. How much can I lose on this trade? How many losing trades in a row can I handle before my account and my mind start to crack? What is my maximum daily loss? Weekly loss? What is my circuit breaker? Amateur traders think, how much can I make on this trade? If you flip that mentality, you are already closer to the 10%. The fourth big reason traders fail is this. They are not actually trading a plan. They are improvising. If you asked most struggling traders to show you their written plan, with clear rules for entries, exits, position sizing, maximum risk, and when not to trade, they either have nothing written, or they show you a few vague guidelines. Buy when there's a breakout. Sell when it looks tired. Use a tight stop. That's not a plan. That's wishful thinking. Without a clear plan, you cannot know if your strategy works. You cannot track whether you are executing correctly. You cannot distinguish a system flaw from an execution flaw. Systems can be tested and refined. Vibes cannot. And more importantly, without a plan, your brain will always default to emotion in the heat of the moment. When price spikes against you, you will reinterpret everything. You will see what you want to see. You will bend your vague rules to match whatever you're feeling right now. A written plan does something crucial. It separates the decision-maker you are when you are calm from the decision-maker you are when you are stressed. Your calm self designs the rules. Your emotional self is only allowed to execute them. Without that separation, you are basically driving in a storm while rewriting the map as you go. Some people hate the idea of a trading plan because it feels rigid. They say the market is dynamic, I need to be flexible. Flexibility without structure is just chaos. Yes, the market is dynamic. Yes, you must adapt. But adaptation should happen outside of live trading, in a structured way, based on data, not in the middle of a trade, based on fear or greed. Traders fail because they treat trading like a series of one-off bets instead of a repeatable business process. The fifth reason traders fail is this. They do not respect the emotional cost of uncertainty. Trading is one of the only activities where you can do everything right and still lose, repeatedly, and where you get continuous real-time feedback on your performance in the form of your changing account balance. That is emotionally brutal. Imagine a job where every 5 minutes your boss walks in and says, your net worth just dropped by this amount, and then 5 minutes later says, now it's up, now it's down, now it's down more. Maybe you're an idiot, maybe you're a genius, let's see. Most humans are not built to be emotionally neutral in that environment. The constant up and down plays on some of our deepest psychological biases. Loss aversion. We feel the pain of a loss about twice as strongly as the pleasure of an equivalent gain. This means a series of small losses can feel emotionally devastating, even if they are part of a profitable strategy. Recency bias. We give too much weight to the most recent events. A few losing trades in a row suddenly feel like the strategy has stopped working, even if they are completely normal. Confirmation bias. We seek information that confirms what we already believe. If you are afraid the market is going against you, you will latch onto every tiny sign that you were wrong and ignore signs that your original thesis is still valid. Overconfidence. After a few wins, we start to believe we are better than we really are. We relax risk rules, get sloppy, and scale size too fast. All of this is happening beneath your conscious awareness while you stare at candles moving up and down. If you don't recognize that trading is, at its core, an emotional endurance test, you will constantly be blindsided by your own reactions. Many traders quit not just because of money losses, but because of emotional exhaustion. They are tired of feeling stupid, tired of feeling out of control, tired of being jerked around by markets they don't really understand, and every time they feel that way, they blame the strategy, or the broker, or the market. But in truth, they were never trained to sit with uncertainty, to handle random outcomes, or to manage their own mental state. The sixth, overconnected to noise and underconnected to process. In the modern world, traders are bombarded to pranas. In the modern world, traders are bombarded with information. Live news feeds, social media, chat rooms, signal groups, Telegram alerts, Discord servers, multiple timeframes, multiple markets. It feels like you're being responsible by trying to watch everything. In reality, you are creating a mental environment where it is almost impossible to stick to any consistent method. Here's how it typically goes. You have a plan. You see a setup. You enter the trade. A few minutes later, you see a tweet from a big account saying the opposite. Some influencer says the market is going to crash, or moon, or that your asset is trash. You start doubting your plan. Then a piece of news hits. Price spikes. Volatility increases. A chat room explodes with messages. Some people are shouting to buy. Others are shorting aggressively. Now you are in the middle of an information hurricane, trying to hold on to your original idea. Most people can't. They bail early, or they reverse, or they add randomly. Their method dissolves into noise. Ask yourself this. How many of your past trading mistakes happened when you were reacting to external chatter instead of following your own rules? Traders fail because they are constantly comparing their own actions to what everyone else appears to be doing. And appearance is the key word. You don't actually know the other trader's risk, time frame, plan, or motives. You are trying to act on fragments of other people's strategies, glued together in your own head in real time. That is not trading. That is reactive guessing. You will not beat focused, systematic players by being distracted and impulsive. The traders who survive long-term are often boring to watch. They have a plan. They execute it repeatedly. They review. They refine. They ignore noise that does not affect their specific system. There is a phrase worth remembering. Amateurs want excitement. Professionals want consistency. The seventh reason traders fail is this. They refuse to experience discomfort in controlled doses, and as a result, they are forced to experience it in catastrophic doses. Let me explain. If you are afraid of taking small planned losses, you will inevitably take huge unplanned losses. If you are terrified of watching a winning trade pull back a bit, you will habitually cut your winners early, and you will never allow your edge to play out. If you cannot sit through a normal drawdown in your strategy, you will abandon it right when the probabilities are still on your side. Avoiding discomfort is one of the core ways humans get into big trouble. We avoid the difficult conversation, so the relationship slowly rots. We avoid going to the doctor, so the illness gets worse. In trading, we avoid taking a controlled stop loss, so we move the stop just this once. Price keeps moving against us. Our position gets worse. We add more to lower our average price. Now we are in a huge position we never planned for, in a trade that was supposed to be small. We are now deep in discomfort, but we tell ourselves a new story. I can't close it now. That would be too painful. I'll wait until it comes back to my entry, then I'll close. Sometimes it does come back. That rewards the bad behavior and trains us to do it again. Sometimes it doesn't. The loss becomes enormous. It wipes out weeks, months, or years of profits. All to avoid experiencing the smaller, earlier discomfort of just taking the planned loss and moving on. If you truly want to become a durable trader, you must flip your relationship with discomfort. You must see small, planned discomforts as the price of long-term survival. Taking the stop is not failure. It's part of the game. Letting a planned winner fluctuate within your rules is not reckless. It's accepting that markets move in waves. Sitting in cash when your system says there's no setup is not missing out. It's discipline. The more you train yourself to tolerate these small forms of discomfort, the less likely you are to get sucked into the big, account-threatening disasters that end most trading careers. The eighth reason traders fail is this. They think knowledge is the same as skill. Most traders are not failing because they are too lazy to learn. In fact, many of them consume a massive amount of information. They watch endless videos, read books, take courses, scroll through social media content about patterns, setups, macroeconomics, and order flow. They accumulate knowledge. But knowledge does not automatically become skill. Skill is knowledge plus repetition, plus feedback, plus correction, plus emotional regulation, plus time. You can read 100 books about flying a plane, but that doesn't make you a pilot. You can watch countless videos on swimming technique, but you will still panic if you are thrown into deep water without ever practicing. Trading skill is built in the same way as any other performance skill. You need deliberate practice. That means choosing a method, defining clear rules, testing it on historical data, forward testing it on small size, recording your trades, reviewing them regularly, identifying where you broke rules, adjusting, and doing this consistently over months and years. Most people will never do that. They want the feeling of mastery without the grind. So they chase shortcuts. They hunt for the one secret indicator, the one magical setting, the one perfect system that will let them bypass the painful, slow process of becoming skilled. But even if they stumbled onto that magical system, they would still need to execute it correctly under pressure. Which brings us right back to behavior. Skill is your ability to do the right thing at the right time, even when it's uncomfortable. That is not something you buy. That is something you become. So, now that we've walked through these core reasons why traders fail, let's challenge the main myth directly. It's not primarily about intelligence. It's not primarily about predictions. It's not primarily about having some secret edge nobody else knows. It is about how you handle three things: uncertainty, risk, and yourself. If that sounds too simple, look at professional trading environments. In prop firms and institutional trading desks, new traders are not just given a pile of strategies and told, "Go make money." They are monitored, trained, mentored, and often psychologically coached. They are given strict risk limits. Their behavior is reviewed. Why? Because those firms know that even with an edge, most humans will blow up if left to their own emotional devices. So what does this mean for you as an independent trader? If you want to have any shot at avoiding the 90% failure rate, you need to approach trading very differently than most people do. Let's talk about how. First, you must redefine what success in trading looks like. If your definition of success is get rich quickly from a small account, your odds are terrible. That path almost guarantees that you will trade too large, take reckless bets, and emotionally blow up. A more realistic and empowering definition is this: success is the ability to execute a proven edge with discipline over long periods of time while controlling risk and maintaining psychological stability. Notice that definition has nothing to do with Lamborghini fantasies or turning a few hundred into millions in a year. It's about process, longevity, consistency. Once you accept this new definition, your daily choices begin to shift. You stop asking how fast your account can grow. You start asking how to avoid being forced out. You care less about chasing one huge winning trade. You care more about never having a devastating losing trade. You stop staring at today's profit and loss line. You start thinking in groups of 100 trades. You start thinking in groups of 1,000 trades. You start thinking about steady performance over entire years. Next, you design trading to fit around the life you have. You avoid trying to live like a full-time day trader. You accept that jobs, family, and duties take real energy. You understand that forcing screens into every spare minute backfires. You become more distracted, more tired, and usually more impulsive. You give yourself permission to trade in a calmer way. You honestly review your schedule and your true mental energy. You choose time frames that match how often you can look. You avoid building a plan that needs constant watching and reacting. You use your sharpest hours for the hardest trading decisions. You avoid placing vital trades late when you feel exhausted. You respect your real life instead of fighting against it. You allow trading to support your life, not dominate it. After that, you commit to one style and one clear method. You stop jumping to a new strategy every few weeks. You stop chasing every indicator, setup, or trending idea online. You give yourself time to go deep with one approach. You accept feeling bored while you repeat the same process. You understand depth beats shallow knowledge of many systems. You become like a pianist who masters entire songs. You avoid being the pianist who only knows short fragments. You choose a method that fits your natural personality. You notice whether you like fast decisions or slower ones. You notice whether you handle pressure or prefer calm conditions. You build your style around who you are, not fantasies. Maybe it's trend following on the daily chart. Maybe it's intraday momentum in a specific index. Maybe it's swing trading mean reversion in stocks. Whatever it is, define it clearly. What markets will you trade? What time frames? What are your entry criteria exactly? Where will your stop go? How will you size your position? Where will you take profits, or how will you trail the stop? What conditions tell you not to trade? Write these down. This is your current working plan. Then, commit to trading that plan for a meaningful sample size. Maybe 50, 100, or 200 trades, depending on your strategy. During this time, your focus is not on making as much money as possible. It's on executing the plan as faithfully as possible, with small risk per trade. Your goal is practice, not performance. You are building the muscle of following a process. Review weekly. Did you follow your rules? If not, why? What emotional triggers made you deviate? Adjust the plan only between trading sessions, not during live trades. This is unglamorous work. It is also exactly what separates people who eventually become competent from those who stay stuck in beginner chaos forever. Fourth, treat risk management as the foundation, not an afterthought. Decide before you trade what percentage of your account you are willing to risk on each trade. For many, that number should be very small, maybe 0.5%, or even 0.25%, especially when you're still learning. Yes, that means your wins will look smaller. It will feel slow. But it also means your losses will be survivable. You are playing a long game. Your primary job is not to make as much as possible, as fast as possible. It is to not blow up. Set a maximum daily or weekly loss. If you hit it, you stop trading for that period. This is your circuit breaker. It prevents one bad emotional day from becoming an account disaster. Respect your stops. They are not suggestions. They are part of the plan you created when you were calm. Know that sometimes you will get stopped out right before the move you wanted actually happens. That is normal. That is part of the cost of doing business. Learn to see that sting as part of the job, not as a personal insult. Fifth, train your mind as deliberately as you train your strategy. If you never work on your psychology, you are like an athlete who spends all their time on technique and none on conditioning, sleep, or recovery. There are simple but powerful practices you can use. Before trading, do a brief mental check-in. How do I feel today? Tired? Anxious? Overexcited? Distracted? If your emotional state is far from neutral, consider reducing your size or not trading at all. During trading, use short pauses. If you feel a surge of emotion, like the urge to revenge trade or the urge to move a stop impulsively, force yourself to take 10 slow breaths before acting. Very often, that small gap is enough to stop a bad decision. After trading, review not just the numbers, but your behavior. Where did you feel the strongest emotions? What triggered them? How did you respond? You can even keep a small trading journal, where you record your thoughts around each trade. Over time, patterns will emerge. Maybe you notice that you always overtrade after a big win, or you always hesitate after a big loss, or you get sloppy when you're bored. Once you see these patterns, you can design specific rules to protect yourself. For example, after a win above a certain size, I will take a 30-minute break before placing a new trade. Or after 3 consecutive losses, I will stop trading for the day. These are not just risk rules. They are psychological guardrails. Sixth, drastically reduce your exposure to noise. Decide what information truly matters for your specific method and cut out the rest during trading hours. If your strategy is based on technical levels on a specific time frame, you might not need to watch every news headline. If your system triggers only a few times a week, you don't need to be inside a chat room that posts 50 messages per minute about every tiny market move. Consider creating a focused trading environment. Turn off non-essential notifications. Close unrelated browsers. Limit the number of charts you watch. Silence group chats during your trading window. Protect your attention like it is part of your capital, because it is. Every distraction makes it more likely that you will deviate from your plan. Seventh, shift your rewards. If you only feel proud when a trade makes money, you slowly train some of your most harmful habits. You start feeling pleased when a reckless, impulsive trade randomly wins. You begin feeling upset when a careful, well-planned trade still loses. Your mind starts chasing random profits instead of steady discipline. You need to flip that entire reward system around. Begin giving yourself credit based only on how you execute. When you follow every rule and still lose, treat that as success. When you break your rules and still win, treat that as failure. You can still keep the money from that lucky win. You must avoid cheering for the mistake that produced it. Over many weeks and months, this gradually retrains what your brain values. You start craving good decisions instead of lucky short-term outcomes. This mindset is how top poker players and elite traders think. They judge the quality of each decision, not the result. Eighth, reshape how you think about time in trading. Many newer traders enter the markets with rushed expectations. They believe a few months of effort should create steady profits. When that progress does not appear, they assume something important is broken. They often decide they are broken, or the strategy is broken. Imagine using that same logic for any serious performance skill. Imagine claiming 3 months of piano practice creates a concert pianist. If I go to the gym for 6 months, I should be ready for the Olympics. We intuitively know that those expectations are ridiculous. Yet we routinely expect ourselves to master an incredibly complex, emotionally intense skill like trading in a fraction of that time. That mismatch between expectation and reality causes massive frustration. After a few losing weeks or months, we conclude that we are failing, when in fact we may simply be in the apprenticeship phase. Nobody wants to hear that it might take years to become truly consistent, but if you accept that, something powerful happens. You relax your grip on each individual trade. You stop needing every week to be a winning week. You allow yourself to experiment, to learn, to make small mistakes and correct them. You start treating trading as a craft, not a lottery ticket. That mindset alone can move you out of the 90% trajectory. Ninth, understand that you are competing against your own worst tendencies, not against the market. People love to personalize the market. They say things like, "The market is hunting my stop," or "They are manipulating the price to shake us out." This kind of thinking might feel validating, but it makes you powerless. If they are always out to get you, then your only way to win is to somehow outsmart a faceless, omnipotent enemy. That story is overwhelming. A more accurate and useful story is this. Your main opponent is not a hedge fund, or an algorithm, or a market maker. It is your own impatience, your own fear, your own greed, your own unwillingness to follow your rules. Markets create opportunities, but they also constantly tempt you to trade when you shouldn't, to size bigger than you should, to hold longer than you planned, to exit sooner than your system says. Your edge is not only in your method. Your real edge lives in your ability to say no. It appears when you ignore a random, impulsive trade. It appears when you choose a smaller, safer position size. It appears when you follow your plan under real pressure. You are not battling a mysterious, evil market enemy. You are battling the impatient version of yourself daily. You are battling the fearful version that hates short-term pain. You are battling the greedy version that craves constant excitement. You are battling the restless part chasing fast wins today. You must protect the wiser part that wants long-term success. True consistency in trading does not appear by pure accident. It grows from thousands of small, disciplined choices over time. It is a side effect of alignment. Your trading style needs to match your natural personality. It also needs to match your daily rhythm and energy. Your risk per trade must fit your real emotions. It must feel safe enough during normal losing streaks. Your long-term goals must fit real market statistics. They must also match your actual skills and resources. Your daily routine must respect your job and family. It must also protect your sleep and mental focus. When these parts fight each other, stress never really stops. You feel pulled in opposite directions almost every session. You battle your plan, your feelings, and the market. Every trading day feels like a draining internal war. When these parts line up, trading still stays challenging. However, the challenge feels fair and more manageable. Losses hurt emotionally, yet they remain inside plan limits. You avoid revenge trading because the loss feels acceptable. Uncertainty remains present in every trade you place. However, it no longer paralyzes you or blocks action. You still make mistakes and break rules occasionally. Yet your errors stay small, contained, and highly educational. You stop recycling the same painful mistake every month. You start noticing real, steady growth in your behavior. This leads to a deeper, uncomfortable question for traders. Why do nearly 90% still blow up accounts regularly? Not mainly because they are stupid. They do not fail because markets are secretly rigged. They do not fail because they missed a magic strategy. They fail because they arrive with broken expectations about trading. They fail because their idea of risk is completely distorted. They fail because they avoid discomfort instead of learning from it. They fail because they ignore the mental pressure of this work. They fail because they push emotional problems onto technical tools. They fail because they demand reward without inner change or effort. If you are still here, you likely want something deeper. You might be exhausted by the loop of endless strategy chasing, new method, quick wins, sharp losses, emotional crash, search again. You might be ready to step off that exhausting wheel. Here is the simple message to carry from this lesson. Your trading edge will probably be small, but still meaningful. Using that edge will depend on your behavior under stress. If you want to last and eventually do well, change focus. Your main job is not collecting more indicators or tools. Your main job is becoming someone who follows a solid plan. You must follow it through boredom and through rising fear. You must follow it through excitement and through nagging doubt. It will take longer than you think. It will be harder than you expect. But it is possible. When you treat trading as a craft, you slow down. You pause before each decision and think clearly. You respect risk on every trade you take. You protect your account as if it were fragile. You train your mind as carefully as your method. You learn to notice fear without acting on it. You care more about staying in the game. You care less about getting rich fast. You aim for steady progress instead of sudden jackpots. You give yourself an edge most traders never build. You become prepared for stress that destroys other traders. A real chance. A chance to improve. A chance to adapt. A chance to stay in the game long enough. Your skills can slowly grow and compound, just like your capital. Over time, this steady growth becomes your real edge. In the end, the gap between most traders is simple. It is not some hidden pattern or magic algorithm. It is a difference in how they think under pressure. It is a difference in how they feel during swings. It is a difference in how they respond after losses. It is a difference in what they are willing to endure. Most people will not do that work. You can choose differently. It's not what you think it is. It's not about beating the market. It's about mastering yourself inside the market. And that, more than any indicator, is where your real edge lives.